In today's video, we're going to be talking about a stock that I've been slowly building a position on as it's been dipping over the past few months. However, in the past few weeks, the stock has been pulling back more aggressively, and that has me wanting to add more aggressively to my position. And the stock we'll be talking about today is none other than Netflix, who's been in the news a lot lately for its potential acquisition of Warner Brothers. So make sure you stay tuned throughout the entirety of today's video. So I'll be showing you how I'm entering into my position, why I'm entering into my position, and also my thoughts on whether this deal is going to go through and whether it's accretive to the position or not. And before we dive in, show your appreciation just by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you can check out their 10 best stocks to buy right now. Netflix has been a tremendous story since the post-pandemic period, and it's also a non-member of the Mag 7. However, when we look at gains, they're pretty much even with the S&P 500, as Netflix has been a much more volatile position. And as you can see from this chart, shares of Netflix dropped more than 50% back in 2022 at one point and are now up nearly 90%. However, when you go from those May 2022 lows, shares of Netflix are up nearly 500% compared to the S&P 500 being up 75% over that same period. So it has been a wild ride, to say the least, and shares of Netflix have been under even more pressure of late, with a lot of rumors that were swirling around the pending potential acquisition of Warner Brothers, which now we have more information on. As you can see here from this fiscal AI chart, shares of Netflix are down nearly 25% in the past 3 months alone. And when high-quality stocks are falling, that's when I'm a buyer. So before we get into the specifics of this current deal, this acquisition of Warner Brothers, let's talk about where we're at right now when it comes to Netflix. The company currently has a market cap of $458 billion. Over the past 12 months, shares are up 6%, but that is underperforming the greater S&P 500 those past 12 months. Netflix is a company that has grown immensely over the years, adding in more products and show offerings, also adding an ad tier as well, which has all led to more subscribers to their product. Speaking of subscriber growth, this fiscal AI chart shows the impressive growth from 2012 when they had 33 million paid subs to today, which is more than 300 million paid subs. However, they stopped breaking out the sub data at the end of 2024. Did you know that in 2025, nearly half of TV viewership is conducted through streaming, whether that's Netflix, YouTube, Paramount, whether it's Peacock, Roku, Disney Plus, the list goes on. But what percentage of all that does Netflix make up? And here you can see a recent report based on Nielsen data for TV usage. 45% was conducted through a streaming service, 24% cable, 20% broadcast, and the remainder is other. Just to kind of show you the growth in streaming, which should not come as a surprise, let's go back to this 2021 report, which shows streaming accounting for 26%, almost in line with that of broadcast, and cable is at the top with nearly a 40% share. The other thing to note on this report is YouTube, and again, I know we're not talking about Alphabet today, which happens to be my largest position, but YouTube in 2021 accounted for 6% of streaming. And now when we go back to the most recent report, you can see they now account for 12.5%, more than doubling its share in a short period of time. And that brings me to the latest acquisition of Warner Brothers from Netflix, which has single-handedly been weighing on the stock. Netflix announced last week that it was acquiring parts of Warner Brothers for $72 billion, a deal that's a mix of cash and equity, giving an enterprise value of the deal of $82 billion. So let's address a few things on first why investors are concerned, beginning with the first thing being that anytime you get into some of these high-priced acquisitions, there's going to be risk involved. Just go back to AT&T. This is something that I covered back in the day when they acquired DirecTV at a time when cable was being cut left and right, and they also acquired Time Warner, adding huge amounts of debt for something that was never really accretive to the business. And the second thing I just mentioned, which is debt. Anytime a company acquires, does these massive acquisitions that involve debt, it's going to have investors rightfully concerned. But Netflix isn't just any company. They have a very solid balance sheet that they're able to withstand this. And they have a company that's growing its free cash flow to easily pay it off down the road. Another risk that investors are concerned about is the legality, the logistics of it from that perspective, because the argument that Paramount is making right now is the fact that this acquisition, if it is allowed to go through, is going to create a monopoly. That just seemingly isn't the case. These are all valid concerns, and if you ask me, the biggest comparison we can look back to recently was Disney's acquisition of the Fox assets, which was a $71 billion deal back in 2019. So now what I want to do is I want to break down these three concerns right here and talk about them a little bit more. So that first one is talking about the risks that come with any acquisition. Not all acquisitions work out. And AT&T is that perfect example of when they went out, spent tons of money acquiring DirecTV. They were stepping out of their comfort zone, which none of these acquisitions really focused on their core business of telecommunication. They bought DirecTV in a time when cord cutting was increasing its rate, and then they went out and bought Time Warner because they wanted to be more in the studio business. They didn't work out. It set back the company a number of years. And then the second thing that we talked about here, the concern, was debt. With the AT&T deal, that brought on huge amounts of debt. But as I mentioned with Netflix, this is going to bring on a lot of debt. There's no question about that. But I believe that because this is going to be an accretive acquisition, where they're going to be able to cut some costs because you don't need two accounting departments, you don't need two HR departments and management teams and all of that to coincide. There's going to be costs that are going to come down to make this deal look more beneficial, but it's also going to increase free cash flow at the same time. And the other angle I always like to look at when it comes to acquisitions is the point of view of the company. Are they acquiring a company because it's a last resort, it's a defensive acquisition? That was the case of AT&T. They were a dwindling business and they said, hey, let's go try and make a splash here with these two big acquisitions. It didn't work out, and they've kind of rid themselves of those, and they're starting to build back and get some momentum again, a slow-growing company. But in the case of Netflix, that's just entirely not the case. This is a company that's firing on all cylinders, to say the least. Revenues keep growing. Operating margins continue to expand. This is a company that's looking to put the pedal down even further. Taking a look here at this fiscal AI chart, you can see revenues continue to grow at a strong clip, generating $6.8 billion 10 years ago to more than $43 billion today. But if you've watched any videos of mine for any amount of time or taken my 6-week Investing Accelerator program, you know that revenue is not a major metric for me to look at. I want to know what's happening internally. And looking here, you can see record operating profits on expanding a record operating margins. The current operating margins are sitting at 29.1%. From a free cash flow perspective, Netflix is generating a record of $9 billion, with analysts projecting $20 billion in 2029 and potentially reaching $30 billion 10 years from now. This is certainly not a defensive acquisition. Netflix has done a tremendous job in the past of taking acquired assets, acquired rights, and taking them to the next level. And now you're going to give them the keys to DC, you're going to give them the keys to Harry Potter, The Sopranos, and the list goes on. Again, they're acquiring parts of Warner Brothers, not the entire thing. They're not taking the cable and reality TV portions. They're not taking CNN. They're not taking TNT or TBS. Just the studio, HBO, and HBO Max. And this brings me back to that final concern that we talked about. The concern that is really being pushed by the Paramount management team. That this acquisition, if it is allowed to go through, would create monopolistic tendencies. And I just don't see that being the case. When we look here, if we put back up this chart with the Nielsen data, you can see that Netflix accounts by itself right now for 7.5% of all streaming. And down at the bottom, you can see Warner Brothers, which is all of it combined, is just 1.5%. But as we just talked about, they're not acquiring all of it. But even if we combine the two, Netflix would jump to 9% of all streaming. Still sizably smaller than that of YouTube. If anything, YouTube is the one building a monopoly. So I don't believe the narrative, and for that, I do believe that this is a deal that's likely to go through. And to mention that, the likelihood of this going through, there's big consequences if it doesn't. from both Netflix as well as Warner Brothers. As you can see here, both of these companies have locked into separate breakup deals. If the deal does not go through and is not approved, Netflix has to pay a $5.8 billion breakup fee. If Warner Brothers calls off the deal for whatever reason, namely a better bid maybe from Paramount, which we've already seen, WBD would pay Netflix nearly $3 billion. But at this point in time, I believe shareholders are sitting in a decent position. Because number one, if the deal does in fact go through, I'm excited about the deal. I think Netflix can take a lot of this stuff to the next level. And even if Warner continues out of its studio to create more studio movies, they're still able to go to the theater. That's a big thing for all of these movie makers. They're not going to go straight to streaming. But to be able to take over DC, that's going to be Batman and Superman and all of that falls under that universe. Take over the likes of Harry Potter, which is uber popular amongst a lot of age groups, whether it's younger, teens, and even older to that perspective there. And so much more there. Sopranos, and the list goes on from a show perspective. Add that into the catalog, reduce some of the expenses, also increase a lot of the free cash flows. There's a lot of things here that I believe is going to be accretive in the long term. It's going to bring on the debt. It's going to lock up capital expenditures for quite some time there, for a few years at least. But looking out long term, when I'm looking to buy companies, I'm focused not on a month or 2 months ahead. I'm focused on years ahead. Am I buying the quality? Am I buying a good balance sheet, good free cash flow, and am I buying at a great valuation? That's what you have to ask yourself. And on the other end of the spectrum, if this deal does not go through, well, then we're back to where we're at right now. Sure, the company is going to have to pay a breakup fee, but that should also provide a pop in the stock because, again, the stock's being weighed down right now. It's down as much as 20% in the past few months, more than 20% because of this deal, how much it's going to cost, the debt that's coming on, so on and so forth. So you're kind of sitting in a good position as a Netflix shareholder. So for me and my personal portfolio, Netflix is a position I want to have and continue to have in my portfolio moving forward. It's also a position on this dip, this more than 20% dip we've seen in the past few months, a position that I want to build up a little bit more aggressively than I had in prior months. And for that, I'm not jumping all in at current levels because I do believe that moving forward, there's still going to be plenty of volatility. If this acquisition continues to go through and Warner Brothers doesn't back out and go towards the Paramount one, this is a deal that's not expected to close until the back half of 2026. But because of that, not wanting to purchase in the mid-90 range right now, I would much rather purchase in the mid-80 range. So for that, I'm going to sell a cash secured put and utilizing an option strategy. And with this strategy, it will allow me to potentially purchase a stock I want to buy at a price I want to buy it. So what we're going to do is we're going to sell the cash secured put with an $85 strike price. We'll sell it roughly 30 days out, so expiring on January 16th, so about a month from now, earning $90 in premium per contract. And for me, I'm going to be selling 6 contracts, generating over $500 in income. This trade, which will obligate me to purchase 600 shares of Netflix at $85 per share if the price were to fall below within the next month or so. If it does, I will gladly pick up shares at that level, and at that price point, based on current estimates, I would be able to pick up shares at an earnings multiple of just 26 times for a stock growing earnings at 28%. That gives us a PEG ratio below 1, and that would have me investing over $50,000. And if you're interested in learning more about options, this Wednesday, December 10th, I'm going to be hosting a 2-hour options workshop, going through a bunch of different strategies that I like to utilize on a regular basis, go through actual past examples and examples I'm looking at forward going into 2026. You can check out that link down in the description below. So let me know your thoughts in the comments below. What are your thoughts on Netflix? Do you think this acquisition of Warner is going to be a good thing moving forward, or is it going to be a bad thing? Are you looking to buy shares of Netflix, yes or no? Let me know down in the comment section. And if you haven't done so, show your appreciation for the video by simply clicking that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.